Hi, welcome to Behind the Data with me, Emma Trevor. Let's take a look at the main factors that have been driving the energy markets since our last update at the end of April. Our top three drivers behind prices this month are geopolitics, LNG or liquefied natural gas, and Norwegian gas maintenance. Our first key driver is geopolitics. It's been an eventful month with several significant developments shaping the dynamics of global energy markets. On the 8th of May, the European Union released a roadmap to completely phase out Russian gas imports by the end of 2027. Although EU reliance on Russian gas has declined since the invasion of Ukraine in 2022, around 19% of the bloc's supply still comes from Russia. As a result, the roadmap raised concerns about how this gap would be filled, increasing uncertainty within the market and pushing gas prices higher, as seen in this chart on screen. Despite this announcement, optimism of the return of Russian gas to Europe was temporarily heightened in mid-May, following reports that the US and Russia were engaged in discussions on the matter. This speculation temporarily pushed prices lower as markets reacted to the possibility of renewed flows. Losses were limited, however, as the European Energy Commissioner quickly confirmed that any ceasefire between Russia and Ukraine would not affect the bloc's decision to move fully away from Russian gas supply. Further price volatility this month was driven by global trade negotiations. After weeks of concern over a potential economic slowdown, several key developments helped strengthen the outlook for industrial demand. Perhaps most significant was a 90-day pause announced between the US and China, with both sides committing to reduce import tariffs by 115%. While this move supported prices by boosting trade sentiment, the temporary nature of the agreement limited gains as markets remained cautious in the absence of a long-term deal. This uncertainty was bolstered further by reports that a US federal court had blocked a number of US tariffs implemented over the last few months. Our final geopolitical driver this month concerns European gas storage. Early May saw the European Parliament adopt a draft law aimed at increasing flexibility in gas storage targets. This draft law, which is still to be accepted by the European Parliament, would reduce the target from 90% of capacity to 83% and extend the deadline from the 1st of November to a flexible window between the 1st of October and the 1st of December. This potential easing of storage requirements is expected to reduce summer refill demand, and as a result, reports of the adoption resulted in a decrease in prices. Our second driver for May is LNG, or liquefied natural gas. Prices climbed throughout the month as supply tightened due to several outages. In the US, planned maintenance at the Cameron terminal reduced feed gas levels, while in Malaysia, an outage at the Bintulu facility pushed exports well below the 5-year average. At the same time, global competition for LNG increased. Taiwan and Egypt looked to increase imports to offset a shortfall in supply, and South Africa explored a long-term LNG deal with the US as part of a potential trade negotiation. This surge in demand pushed prices higher as European buyers competed to secure cargoes. Our third and final driver this month is Norwegian gas maintenance. As Europe's largest gas producer, Norway's infrastructure plays a critical role in the regional supply. While this year's maintenance schedule has seen fewer revisions than 2024, a significant event in the end of May added to upward pressure to prices. A partial outage at the Troll field, responsible for 42% of Norway's production, was expected to end on May 23rd, but was extended and is still currently in progress, as is shown in this chart. The resulting loss of supply contributed to a risk premium being priced into the market. And finally, looking forward, one thing to look out for this month is Asian weather conditions. As we enter the summer months, rising Asian temperatures will drive cooling demand and likely result in an increase of LNG imports to meet the rising demand. Imports to South Korea and Japan have already increased significantly over the course of the last month. and a continuation of this trend will further heighten global competition and may therefore drive prices higher. Thank you for listening, and I hope that you found this update useful.